Okay, perfect. I think we gave enough time for everyone to join. I think we're still waiting for a few people, but I think it's okay. We start as I'll just introduce. So my name is Tiago, and I have with me Nikolay Nikolov. We work for the Watchdog Dogs Group, specifically. Today, focus on SPI, Structured Products Intelligence. It's a new brand of the group, which we created to provide threefold. One, market intelligence on structured products. Second, reference data. And third, life cycle of all global structured products market. Although we started in the US and we're now in Canada, we are now expanding to the European market. And on that, what we decided, we wanted to give something back to the industry. So we decided to do today a short webinar on the French structured product market and show you some of the trends we're seeing and our forecast for 2021. So on that, I'll give the word to Nikolay, who will explain you more about the agenda for today.
Good afternoon, everyone. My name is Nikolay. I'm a structured product analyst with SPI. Thank you for shortening your lunch break at attending this webinar dedicated to the France structured product market. I hope you'll find it useful enough to attend it regularly. So today I'm going to present the first part of this quarterly market review. I'm going to start with the market volume, the payoffs, what's new with the underlyings, and the capital protection. And I'm going to hand it over back to Tiago, who will follow up with some analysis on the yield currently being offered and versus volatility and equity performance. We'll finish with our forecast and rollover speed for in 2021 going forward. So just a brief footnote before getting to the topic. SPI currently covers the market across medium-term notes, certificates, and structured funds. And our coverage includes public offer and private placements. So for the latter, we estimate our coverage to 60% of the privately placed deals, but our coverage is rapidly increasing. Now then, the chart you see on the left shows a positive market growth in the first quarter, with about 5% more in deal volume than in the same period last year. So the chart on the right shows the quarterly growth fluctuation. So maybe a quick word about the contextual impacts last year. First, there was the post-rollover from outcalling products, and that continued in most of the year. Then there has been the increased volatility from March onwards, and that helped building interesting structures. Given the lack of rollover, most of the volumes in 2020 came on the back of new investment. It meant that without much to recycle, structured products managed to attract a record new inflows from other asset classes, mainly from the life insurance fund euro and from the equity funds for the securities wrapper. And as a result, despite a negative 10% year-on-year market growth last year, the outstanding volume didn't stop to grow and increased to an estimated 32 billion euro, as new investment have to a large extent come to offset the lack of rollover. So the first quarter of 2021 was very successful, with an estimate 5.2 billion worth of product, which were issued since the beginning of the year. Just to clarify that the chart is based on products issue date. It means that for those campaign products that were issued in quarter one and that are still in subscription, we base the volumes on a projection. So to sum it up briefly, we see a recouping quarter-on-quarter growth, which is to say that structured products are now drawing even more investment than they did in the previous years. And that said, we are seeing very good rollover speeds of expiring products since March, and this is something we are going to elaborate on later on during this presentation. So now here's our updates on the principal payoffs. So speaking globally, the market remains dominated by the autocall product, which account for 94% of the deals. Yet, as always, there have been a few developments in terms of the sub-features of the Autocall, and I'd say it was mostly towards more defensive products. So the main development is that products with airbags at maturity have increased and now represent over a fifth out of all payoffs. The rationale is that this type of product are more defensive than the plain Autocall, as they allow to secure a positive result at a significantly lower market target. So the next thing I would like to stop your attention at are the so-called late Autocalls, which represent themselves a combined 23% of the market in the first quarter by sales volume. Basically, these are products which block the Autocall feature over 2, 3, 4 years, in which time a fixed coupon may or may not be paid depending on the structure. It also worth noting that this type of product often come with negative Autocall barrier on the observation dates, and as such, they are kind of similar to the defensive step-down barrier Autocalls. The idea is that when the Autocall is to commence 2, 3, 4 years from the strike, it will have absorbed a potential market fall down the line. Products offering some sort of participation represent 10% of the volumes with a combined 8% year-on-year sales growth. So we split them in two categories. So first include classic participation products, and the second group are participation products with Autocall feature. So last year we saw the Autocalls with full upside, the so-called Athena rebound, and this year it have been more volumes on the side of the bullet Autocall structure, so observation in the middle of product's life cycle. You can see the figures in the table, and before moving on to the next slide, we've seen the Phoenix memory structure decreasing by about 20% year on year. This is the structure that recorded the biggest negative growth in Q1. On the other hand, we see about 8% is the part of products combining both Athena and Phoenix strategies, also called in market jargon Athenics, which generally split the coupon in two halves. So first half being offered in slightly falling underlying, and the other half in the event of moderate rise of the market. Now, the underlyings. So structured products distributed in France are mainly linked to a single underlying, and this has been the case again in Q1. 3 out of 4 of the products are linked to single index, but this group went down by 4% compared to same period last year. On the rising side, we see an increase in the more targeted exposure to stocks. Although it's many single names, we are seeing them getting outpaced by worst of structures in terms of year-on-year sales, because worst of structures were up 60% compared to 35% for the single equity, single stocks linked products. And indeed, it's like correlation has come back down to normal levels. The volatility was decreasing, so it's a way to keep the currently offered coupon high by adding a worst of mechanism. So in the same time, we see a 46% growth for the more defensive equally weighted stock baskets. So although they are quite rare in the market and represent 2%. Now, I started with what isn't the principal developments. It was not meant to avoid the elephant in the room. Decrement indices are currently the dominant underlying with half of the deals volume. And I'm skipping the definition. The fact that it's getting difficult to hedge the dividends and to find attractive conditions on the classic benchmarks had led to decrement indices growth. Sometime in the same time last year, they accounted for 30%, and the Euro Stoxx 50 represented 42%. So now the reshuffle is not a surprise, to say the least. That said, let's take a look at the various investment thematics, which are now currently being deployed mainly via this group of indices. And you can see them in the small circle. Of course, the ESG thematic continues to rule with 56% of the decrement index group. Their market share is 37% of all index-linked products and just below a third out of the global offer. So this quarter, it has been an 83% year-on-year sales growth for the decrement indices. That said, new thematics other than ESG appeared, or some not so new got traction in this first quarter. And these are the oil team, the technologies team, as well as exposure to new geographic regions, which got more growth and increased their market share. So oil-themed underlyings have recorded the biggest year-on-year growth with a combined 120% up. That was largely on the back of the iStocks Europe 600 Energy X Coal Decrement Index, which also experienced the biggest year-on-year growth with the indices you can see in the table. Then new technology indices have been introduced in the shape of the Nasdaq Global Innovative Tech, the Selective Homestead Technologies 220. From the stocks linked products, we've seen next to the more usual names like ST Microelectronics, Atos, some new names which are new for the market, like for example, NVIDIA, SolarEdge Technologies, Enphase, Infineon, semiconductor companies, Stellantis, some other electrical vehicle companies. The pharma sector got traction itself with Europe and US top pharmaceuticals 220, and as well as via a number of shares of pharma companies. But next to these new thematics, there was also some shift in the exposure to overseas equity. So indices comprised of North American and European shares recorded a 277% year-on-year growth and represent about 9% of the index-linked product group. These are indices, so these indices are the iStocks Transatlantic ESG 100, Euronext Transatlantic ESG Leader 60, the S&P Transatlantic 40 ESG Momentum, but also more targeted exposure via the Europe and US top pharmaceuticals and select Europe and US top banks 2020. The Eurostoxx 50 linked products and the banking sector are the only ones that experience a negative year-on-year growth with -30, -55%. And the top underlyings, which you can see them in the table, account for over half of the volume in the first quarter. So now the capital protection. Of course, the capital protection is one of the most praised features of structured products, and 2020 showcased that perfectly because, let's remind it, almost no index-linked structured products lost capital caused by a breach of a knock-in barrier at the height of the crisis. On the other hand, so the environment is durably favoring structured guaranteed capital products. So the few issues offering partial protection represent no more than 9% of the volume and are mainly distributed by branch retail networks. So that said, the offer continued to be dominated by soft protection in the shape of a knock-in. So although it may appear weird, so the beginning of 2021 as being kind of similar to the beginning of 2020, to the extent that the bull market trend seemed not weakening in the first 2 months. So let's have a look at the barrier level now and back then. This quarter, the average absorbed market fall to protection has increased by 3%. So the bulk of the products have a knock-in barriers at 60% from the initial level, and it is currently down 12% year on year. Knock-in barriers at 50% increased by 36% and represent nearly a quarter of the volumes. An additional 5% of products got even deeper capital protection. Of course, the barrier level has always depended on the choice of the underlying, knowing that the market index will usually go with higher knock-in level than a decrement index. The small charts show how barriers have evolved for each of the main underlying categories. Interestingly, we observe the inverse trend with a single name linked product. So the part of 60 barrier increases at the cost of knock-ins at 50%. But it's also true that the maximum term of single name products has shortened by an average 3 years compared to Q1 last year. And we are giving more details on that one in one of the next slides. So here, I'd like to pass it on to Tiago for the next slides. Tiago, over to you.
Perfect. Okay, thanks, Nikolay. I think Nikolay told us a bit about underlyings, the payoffs, and of course what we also want to show you exactly, why this is happening, why is it growing, and also what does it mean for 2021. So I know I have a lot of information on this slide, but I'll try to explain, and I'll start with the left graph. So what you see there as in the blue line is the offered coupon average per month with the capital plus the coupon. And on the gray lines, you can see the performance of the Euro Stoxx 50 net return. So it has included the dividends. And you can also see the VIX, the Euro Stoxx volatility index, to see how it behaved. And we looked at, of course, we have a couple of periods that we need to think about. First is beginning of last year, the evolution throughout 2020, and of course the last 3 to 4 months. And what you see is that, okay, during this period between Jan 20 and March 21, although on the graph you can't see it, the coupons offered back in beginning of 2020 were around 6%, 6-7% before COVID. What happened, of course, when volatility started to increase rapidly in February and March, basically those offered coupons started to increase. And of course, with then the recovery of the equity markets between March and May, and again until towards the end of the year, we saw that the offered coupons got to a maximum of 9% per annum coupon around June, and since then have been slowly decreasing. Now the reasons for that is of course the dividends, but if you exclude on the decrement indices, of course it will be the volatility, and you can see that the volatility since April 2020 has been slowly decreasing, which means that those offered coupons continue to decrease. Nevertheless, these high offered coupons, they actually seem much higher compared with the current interest rate environment, with the ECB maintaining interest rates, even long-term interest rates, negative. What does it mean? It means that this high yield help attracting new money. And what you see also there during the last period, the last 4 months, is the average offered coupon depending on the barrier level, okay, as well as by the underlying itself. And what we see is that during the last couple of months, we saw a small increase, mostly on the 50% barrier level. That it went from 6.6% offered coupon back in December 20 to 7.6% in February and March, which it also means that it attracted investors. What is interesting, and I think it fits very well with what Nikolay told us, is although the decrement indices are still the majority of the market, and as you would expect with the decrease of volatility, the offered coupon on those decrement indices is now starting to slowly coming down, although you saw a small increase in March due to, again, the volatility. We see a comeback on single shares, worst offs, and sector indices as themes that investors are looking at, and it's also a way to get higher coupons. You can see that although decrement is still 50%, you can see that single share, worst off, and sector, they now represent more than 15%. And you can see that in the worst off, now they're offering a coupon more than 10%. And I think that's helping a lot the rollover speed of products maturing, being rolled over into new structured products. Now, before I go and give you a bit of a flavor of what we expect for 2021, it's also important to highlight another trend, which is a big split that is happening. So again, for the past 6 years, the French market started to increase the term of the products, going to 6 to 8 years. Now, what we see is that is actually a split. The products that used to be around 8 years are actually now being split into two types. One is the short maturity, okay? Year on year, so for the first quarter, we see an increase of 173% year on year of products with 5 years or less term, which now represent 50% of what it was sold. And we also see an increase on the longer terms of 12 years maturities, which has a 30% growth compared with the previous year. I think it's, it's interesting to highlight is that because of course having less expectations, or at least not knowing exactly how equity markets are going to behave. I think we've seen these two split, and of course the volatility, the short-term volatility, also helps it offer higher coupons into the short-term products. And I think that's probably a trend we will see during 2021, and mainly focus on single stocks or war stocks. While on the longer maturity, I think we will see the structured funds and the UCITS industry going into more long-term and 12 years maturities, which is interesting. It doesn't mean it's bad for the industry. I think quite the opposite. It means that there is more diversification in terms of products. And again, to give you our estimates for full 2021, we also need to have a look to back to 2020 and how it behaved. I think the biggest chart here that explains everything is, of course, the rollover speed, which basically gives us the expiry volume versus the outstanding in the market. And what we see is that back in February, it was between 4 and 7% of total volume maturing every month. What happened is, of course, when equity markets decreased back in March, that means that all the autocallables that should mature earlier, actually they didn't, because they were below their strike level. So what we saw is that a massive decrease into almost an average of 1.5% rollover speed. And why we are very positive for 2021 is, of course, we are now seeing, because when equity markets recovered, we're now seeing all this volume coming back to the market. And back in March, we estimate that was almost at 5.5%. And if current levels are maintained, that this would actually increase. Now I explain on the next slide exactly our estimates. Nevertheless, I think something which also meant for 2020 is that distributors had to look for new money. And what we did here is we compared the amount issued versus the expired and matured every month. And we basically did a net inflow on structured products in the French market since beginning of 2020. And what we saw is that it was almost 10 billion euros of net inflows into structured products. Again, this doesn't take into account the unwinds, but we believe that a lot of this is actually new money, as distributors had to find.
Tiago, just the slide, probably you need to change the slide, I think.
Yes. Okay. Okay, so as end of the forecast for 2021, I think, Nikolay, you've seen the forecast for 2021?
Yeah.
Okay, perfect. So taking into account the rollover speed and of course the new money that went into the market, I think we give you here two charts. One is we took into account all the outstanding products in the French market. Okay, and we analyze, their current levels okay, as well as the potential expiry date. And there are a couple of things is that we believe there will be almost 19 billion euros expiring in 2021, which which allows us to say that, compared with 2021 forecasts, we believe we're going to get to 22 billion euros of sales on structured products in 2021. And this compared with 17 billion back in 2019 and 15 billion in 2020. Just to put a bit of, in terms of percentage and growth, we're talking about 30% growth compared with 2019 and a 47% growth compared with 2020. And again, what's the main reason? First is a lot of the products that were issued back in 2019, as well some in 2020, are currently in the money and should expire early. So we believe that will be around 15 billion euros of autocalls maturing during 2021. So as we are finishing our presentation, of course, we will open for questions. I didn't mention in the beginning, but you have the Q&A section within Zoom, which you can put your questions in. Okay? And of course, Nikolay and I will be glad to answer any questions that we get in the couple of next minutes. Okay, of course, again, looking at the Q&A, basically, of course, we'll be glad to answer any question if you'd like to tell us. Well, Nikolay, while we wait for everyone, thanks for doing the presentation and for doing the webinar. Hope that people enjoy it. I was actually quite surprised by, by the potential growth on the autocalls. Okay, we'll give a couple of more, 1 more minute to any question. Okay. Look, I think, okay, we have a question, Nikolay. Can you please come back to the single stocks that were most traded in 2020 and 21? Nikolay, you know by heart exactly what all the products. So can you tell us what were the most popular single stocks in structured products?
Well, yeah. So I think the usual suspects, so to say, are like total property companies like Bouygues, Klépierre. So also companies look sector like LVMH. Yeah, I think, yeah.
Quick question from me, Nikolay, to add this. I guess, so you mentioned a lot of French stocks. What about, let's say, thematic, like technology sector, like Tesla? I know it's been quite popular in other countries.
That's the new thing, because if last year, like same time, popular stocks are, as they say, so Bouygues, Klépierre, Unibail, Rodamco, so of course oil sector, Total. Now, so that basically these were French stocks, French equities. So now we see different equities, like for example Tesla, like Stellantis, like even Asiatic electrical vehicle producers like NIO, semiconductor companies like Infineon, so Enphase. But that's it's it's still early to say if it's a trend, because that's the new thing. But if it will be a trend, so we'll see it.
Okay, perfect. Thank you, Nikolay. Look, I think we're going to end the webinar. Oh, I guess we have another question. Are you able to do the same for other regions like Switzerland, Germany? Yes, I think it's our goal to continue doing these webinars, mostly quarterly, into different regions and to different markets. So please be watchful and follow us on LinkedIn. And yes, it's planned. We're planning to do these webinars while we're building our online portal, SPI, spintelligence.com. And we actually have a lot of news on that, because you will be able to follow every single product, how it is performing against the barrier, what you'd expect to get into the maturity, and so on. So please follow us and wait to see what we're going to give back to the market. Okay. Then we also have another question, which is, do you have any idea of the split between public offers and private placements?
Yeah, we have it. We have that. I think normally I cannot say it right now, but if I have it, I can answer this question probably in email.
Okay, perfect. Look, well, I think we'll answer. We don't know exactly who it is, but I guess what we can do is we are going to send the presentation to everyone who attended. Okay. How are volumes divided between public issues and private placements? Do you have an estimate, Nikolay, from what we currently have?
No, I would prefer not to answer just right now. So just leave your contact. I'll answer that.
Perfect.
I can do it afterwards.
Perfect. We'll come back and we will add that on our email. Okay. Thanks. But thank you, everyone, and thank you for all your questions. Hope it was useful. And yeah, please follow us. We have plenty of news and updates that we'll give back to the market. So thank you very much and have a nice day.
Thank you. Thank you for listening.